Hi, welcome to today's webinar. It is Ed Pagecroft here from Stockopedia, and today we are doing a value investing special webinar. We have normally done webinars on things like the stock ranks, on site orientation, on reading stock reports, on using the site, and they are all available on our YouTube channel, which if you just Google for Stockopedia YouTube, you will find it. And you can also find it on the website under the help menu on the webinars page. But today we're going to be focusing on value investing. A lot of the content that we will be discussing has been available in one of our books, which I'll be showing you shortly. And I'll be spending a little bit of time just introducing some of the value investing ideas and then going on to showing you how to apply them on the website. So this is very much a value investing focused webinar, and hopefully get a lot out of it. What I've realized in preparing some of this material is that this is a huge topic, and really it deserves a lot more time than just a 45-minute to 1 hour session. Just to let you know, we are going to be doing courses in investing next year, I hope starting in January. So we will be doing and breaking this material down into separate webinar sessions, which we will sequence in sets of 8. So stay tuned. We'll be emailing everybody and putting information on the site about that in due course. So yeah, just stay tuned for that for next year. Before we get started, here is a quick disclaimer. Just to say that nothing in here is investment advice. It's very much educational. We are not a financial advisor. Any stocks that are brought up are to be taken as illustrative and not as recommendations. So very important to bear that in mind, especially some of the strategies we will be focusing on, especially deep value strategies, which are often full of very, very, very risky stocks. So beware of that, and but try and learn some of the ways to mitigate some of those risks during the webinar. Okay, so first up, I'll be introducing the book, How to Make Money in Value Stocks. I will show you some of the key concepts from that, a little bit of the history of value investing, and showing you how to hunt for deep value stocks, showing you some of the problems in deep value stocks, and also showing you how to improve the returns from the value bucket. And then obviously we'll be going on and showing you some of the value investing tools in Stockopedia. So we might as well crack straight through. Basically, you can find the book at this link. I have posted it in the chat room on the GoToWebinar panel. But it's at that URL. I do recommend you go and navigate to it if you're on a computer now. And essentially, it's an ebook. It's about 60 to 100 pages long. You can read it in about 2 hours. And it's a very brief synopsis of everything that's been proven to work in value investing. And I think it's got, there's a lot of fantastic content in there, and it illustrates a lot of the kind of guru strategies that you can find and implement on the Stockopedia website. From the source of Benjamin Graham, who I'll be introducing in a moment, and his experiences in the 1920s, to a lot of the kind of more modern minds who've shown how to improve value investing returns. So do download it. If I flick to the website very quickly, if you're on the website, you can hover up on the toolbar and go to the help menu. And right at the bottom here, you can see read our ebooks. If you click on that, you end up on this page, which has some of our ebooks, and we're always, all the blogs that we do on the website, we tend to try and package into these ebooks. And eventually they're going to become online courses. So this first one on the top left is How to Make Money in Value Stocks. If you click it, it's there. There's a summary of it. And you can see here all these buttons. Excuse me, I do have a winter cold. But it's available free to all subscribers. You can download it as a PDF, iBooks, Kindle, or you can take it as an email course, or you can read it all online just by scrolling. So you can take it around with you on your iPad or your phone or however you want to read it, or you can just read it online. I'm proud of this little bit of work. There's a lot of good stuff in here, and it was a real team effort to pull it together. So I'm not going to go through everything in it, but that is where a lot of this content and these ideas come from. Okay. So let me just give you a quick brief history of value investing. A lot of value investing really comes from Benjamin Graham. He's kind of got the title of the father of value investing. And I'm hoping I'm not sort of teaching grannies to suck eggs here, but he wrote some fantastic titles. He wrote Security Analysis, which almost invented the industry of security analysis in the city. He also wrote a book called The Intelligent Investor, which is highly recommended by Warren Buffett. But a lot of people often don't realize that he actually was a tutor at university in America at Columbia Business School, where he taught Warren Buffett himself. And Buffett's early success was that he put entirely down to Benjamin Graham's teachings. Graham himself actually lost a fortune in the 1929 market crash in America. And that really led him to reassess his methods and put a huge focus on what's become known as the margin of safety. And he wanted to ensure that he could never, ever lose money again in the stock market. And this reassessment of his strategies led to a 17% annualized return, which made him a very wealthy man in the rest of his career. And essentially what this strategy came down to was understanding, firstly, that all stocks have what you might call an intrinsic value, the real genuine value of a company. And that is not the share price. The share price tends to waver in this black line around this green line, around an intrinsic value, which is a lot more stable. And he called the mechanism that sets prices Mr. Market. And Mr. Market, he sort of had this idea of Mr. Market being a manic depressive. Some days he's really, really excited. Some days he's really depressed. And he'll quote you different prices based on the mood he's in. And this is his sort of metaphor for understanding why the market price is not always at the intrinsic value. And what he wanted to do was to try and buy from Mr. Market companies which were selling at a massive discount to their intrinsic value. So if you look on this chart, you can see the blue area might be the buy area, and that would be at the largest, what he would call margin of safety beneath the intrinsic value. And value investors try to either systematically or in more of a stock selection fashion, buy shares at deep discounts to intrinsic value and then hold them up to a point when either they are fairly valued or they're overvalued. And this is a key concept in this contrarianism in value investing. Now, Ben Graham taught a class full of of students that became incredible investors. He taught there over many years. And Warren Buffett in 1984 wrote an essay called The Super Investors of Graham and Doddsville. And he showed that it was beyond chance that so many fantastic investors could have come from one man's class. It cannot be possible that it was random that Warren Buffett himself was such a sort of wealthy investor. If all these other great investors came from the same classroom, Walter Schloss, Bill Ruane, etc., they all were steeped in this idea of in these ideas of Benjamin Graham. And looking at some of the returns in that chart, it's quite astonishing how well they did over very long time periods. So value investing has worked for a very, very, very long time. This is the actual quote from Buffett's paper where he says, "I think you will find that a disproportionate number of successful coin flippers came from a very small intellectual village called Graham and Doddsville." Now, Warren Buffett started his whole career in value investing just buying what are called deep value bargains. And I'll be showing you ways to screen for these deep value bargains very soon on Stockopedia. He's been quoted as saying value investing is simple, but it's not easy. So I wanted to break this down and just show you how and why value investing is simple, and then show you why it is actually so difficult in practice. I often talk about the value effect and say that cheap stocks outperform expensive stocks. Really, portfolios of cheap stocks have a tendency to outperform portfolios of expensive stocks over every sort of 2 or 3 year cycle. Now, if we can break this down and actually look at and understand what cheap is and where you should position your portfolio to buy cheap stocks, it's quite useful if we look at it like this. If we were to rank the whole market, and I'm going to presume all of you understand what a P ratio is, but if you were to rank the whole market from cheapest price earnings ratio to the most expensive price earnings ratio, in order of descending cheapness or increasing cheapness, so that you have at the top of this list all the cheapest stocks by their P ratio, and at the bottom you have all the most expensive stocks by the P ratio. We can cut that into 10 buckets so that we have buckets of shares in the UK market, let's say 200 in the top set, 200 in the bottom set, all the way down in descending, in increasing expensiveness. We can then hold those portfolios in a sort of virtual basket and track their portfolio over time. So in that cheap bucket, you might expect stocks like Tesco at the moment. It's very, very cheap. In the expensive bucket, you might find stocks like ASOS. So the green line on the top here would show you the cheap stocks, and the red line on the bottom would show you the expensive stocks. And this is what we do, and we've been tracking at Stockopedia using what we call the value rank. And the top line here shows you the actual results in the UK market of stocks with a greater than 10 million market cap that have been cheap over the last couple of years. And the red lines show you those that are expensive. So I think I am illustrating that with our statistics on the market, value investing has worked over the last couple of years. But it's not only us. There is so much research out there that has now analyzed value investing returns. It's like a science now. This is just a chart from the Brandeis Institute, where you can see on the right here, this column, the height of the column is the annualized profits for each of these 10 buckets, from expensive on the left to value and cheap on the right. And you can see that it's very, very clear that if you invest in cheaper stocks, one will have a higher probability of beating the market, which is something obviously we all want to do. But obviously Buffett said value investing isn't easy. So why isn't it easy? I'm just going to rattle through this because I know everyone's keen to get on the site. Value investing isn't easy because in that basket of cheap stocks, there are a lot of problem stocks. People often, they don't like buying problem stocks because they're difficult to own. They're not consensus trades. Very few have enough patience or tenacity to see value investing through, because often value investing can take 2-year cycles for it to consistently outperform. And if you underperform significantly for 1 year, you're bound to throw in the towel. So bear that in mind. One of the problems in value investing is it highlights lots of what we might call value traps. So in that cheap bucket, you find there are sectors in long-term declines, there are obsolete business models, there's lots of competition, there are often governance issues. It's a nasty set of stocks. And Seth Klarman, who is one of the best value investors around at the moment, has been quoted as saying the possibility of sustained decreases in business value is the dagger in the heart of value investing. And it really is. There is this real problem in the cheap bucket of stocks that if you just buy 1 or 2 stocks, you might end up with stocks that can go bust. And as I was saying, value investing doesn't work all the time. I know I'm rattling through these slides, but I will send this PDF to everybody who's on this webinar list. So if you can go and then look at it at your own leisure, and we will put this on YouTube. But you can see here several times where over 5-year periods, the value investing has underperformed the market. So it will underperform occasionally, and also there can be significant drawdowns. In 2008, value strategies had 50% drawdowns. So one must expect, just because value investing works doesn't mean it's not exposed to some of the risks in equities that you are familiar with. But if you want to have better performance than the crowd, you must do things differently from the crowd. So John Templeton, great investor, built an amazing asset management firm, and famously one of the best value investors there is. And he was very, very happy to go against the crowd. So how do we solve this value problem? Well, there's a couple of ways that we can do this. One is to take a sort of broad brush approach that Ben Graham liked to promote, which was to diversify. He would say buy 30 stocks that are really super cheap, and you will have safety in numbers. The ones that will rise will more than cover the ones that will decline. But as time has gone on, smart investors have realized that actually if you can separate the winners and the losers from the cheap bucket of stocks. And there are several techniques for doing this. One most famously, which Warren Buffett has really made famous, is to try and buy good companies cheaply. Joel Greenblatt is another hedge fund manager and educator who has really promoted this philosophy. And we do publish some techniques on the website, which I'll show you, which are inspired by his methods. But there's also Joseph Piotrowski, who creates something called the F-score, which is one of my own personal favorite metrics, which I will show you on the stock reports, where he tried to buy, he has a strategy which tries to buy bargains that are on the mend. So separating the winners from the losers, finding the turnaround stocks, the ones with the best fundamentals in that set. And discarding and leaving and not buying the ones which have declining fundamentals. So that's another great strategy. And lastly, Joseph Lakonishok, which is to really using momentum to you can think of it like this. You take the set of value stocks and you find the shares whose share prices are rising the fastest from that set. It's generally a signal that they might be turning around. And this is, you can call this a value and momentum strategy, but it is extremely effective at weeding out the worst stocks from the value bucket. So just to show you how this kind of works, on the site, these are some charts from Stockopedia, from our own ranks. The grey line here is the FTSE All Share. This pale blue, cerulean blue line is the value rank. This shows you the cheap bucket. The darker blue line shows you good and cheap companies. So this is the ranking for good and cheap. And the black line shows you cheap but improving stocks, which is more value and momentum. So you can see you can improve this basket of cheap stock returns by applying quality and momentum to that value basket. So I'll show you how some of the ways we can do this on the site in a minute. So what I know I'm always accused for rattling on too much in these webinars on the theory. So I've only got 2 more slides to show you. Very quickly, in the book, we do have a whole chapter about value ratios. I don't have time to go through all of this right now, so I want to spend more time on the site. But some of the real basic ratios for value investing are listed here. Price earnings ratio, most people understand. It's best for stocks with kind of normal profits. On the right here, I've given you some metrics which I've taken from the website today, which show you the cutoff point where that cheapest 20% of stocks, sorry, it's actually the cheapest 25% of stocks are at the moment in the market. So on the P ratio, if you find a stock trading on a P of less than 10, it is in the cheapest 25% of the market. If I was just to flick back and show you, for example, in the value chart here, the top few lines here are the cheapest 25%. Or we can see on this Brandeis Institute chart, the cheapest 25% would be these sections on the right here. So focusing one's efforts on the cheapest segment of the market can literally pay dividends. So there's some other cutoffs here. And one of the things one has to understand about value ratios is they all measure slightly different things. So they all measure the price of the company against either what a company earns or what it owns. And the cutoffs are a little bit different depending on that. So you can see here for the price to earnings ratio, the cutoff is at about 10 at the moment. Price to cash flow ratio, which is what most people think is better than the PE ratio, because earnings can be fiddled by the accountants or by the management by doing some little nifty tricks on the accounts. So actually using the price to cash flows is often a much better way of measuring value. But again, the cutoff there is about 10. So the cheap bucket is price to cash flow of less than 10. Price to book ratio looks at the price of a company against what it owns or its sort of net worth. And that's best kind of for old economy or asset plays. It's not necessarily as good for sort of a lot of modern companies. But the cutoff there is at less than 0.8. The price to sales ratio is best, it was really popular in the .com era, but that's best for stocks with no profits. And the current cutoff there is at about 0.7. And the PEG ratio, lots of Zulu kind of investors like this. It compares the P ratio with the earnings growth rate, and the cutoff there is about 0.45. There's a couple of Ben Graham bargain ratios I'll show you how to screen for in a minute. They could take an entire webinar on their own, but very quickly, Ben Graham came up with some ratios which essentially tried to be the safest possible metrics to try and find stocks which were trading at less than the company's liquidation value. And he used a couple of custom methods which have got a lot of jargon in the title: price to net current asset value or price to net working capital. One shouldn't be afraid of the titles. Essentially, they're trying to find deep bargains. The cutoffs for the cheapest 25% are at about 2.5 for both of them. But he liked to look for stocks that were trading on less than 1. But there are problems with this, as I will show you. If you want to improve the value returns, I'm going to show you how to do this in Screener after this slide. But there's a few popular methods here. The return on capital, which is on all our stock reports, the F-score, but I prefer to use the quality rank, which is our own custom metric. Similarly, there are a couple of momentum ratios. I'm not going to go into any more detail on this now. I'm going to get straight stuck in on the website. I wanted to show you very quickly a little bit of navigation around the site for finding value stocks. So let me start with the home page. If you scroll down and you go to the stock rank section, which is just down here, you can find some of the value rank stocks here. There's a little link here which will take you to the list of the cheapest stocks by their value rank, which you can click, or there are some screening recipes here. So if you want to find value and momentum stocks, you can use these lists, or good quality value stocks, you can use these lists. But a lot of people are interested in the guru screens. If you go up to the top menu and you click strategies, you'll see them right there under guru screens. So let's click through and have a look at this. On this page, I'm going to just restrict this just to the UK at the moment, which is here. And let's look at the annualized performance since inception. This page, if we can actually filter this by category on the left menu. And there are a few categories which relate to value investing. There is the general value investing bucket here, which has 15 strategies in it. There's the bargain stock strategy, which is kind of Ben Graham domain, which I'll show you first. But there's also quality investing and there's also dividend investing. So I'm going to start by looking in the bargain stock strategies because I think it's quite educational and it starts with Ben Graham. So if we look here, we can actually see there are several Benjamin Graham strategies which have done particularly well in the UK, but not so well internationally to date so far. The most famous Ben Graham bargain strategy is this Ben Graham net strategy. So let's have a quick look at it. And I will illustrate why this is such a dangerous strategy to use in a market environment like this. I would say if you're going to look for bargains, the very, very, very best time to look for bargains is after a sustained market rout. If 2008 was a fantastic time to go bargain hunting because these lists filled up with tons of really good shares with shares that were trading for less than their cash, etc. After you've had a bit of a bull market like we've had the last few years, it gets filled with what I would call a lot of highly low quality shares and micro caps. So if you scroll down, you look at the actual qualifying shares, you can see this is using one of those difficult terms that we looked at a moment ago called price to net working capital. You can read up on it in the book, but essentially this will find a lot of microcap shares because the market's gone up so much. And this list will get full of trouble companies. In here, you find a lot of the Asian shares, the Chinese AIM stocks that people keep. It's almost like a barge pole list. But surprisingly, it has outperformed. One of the other troubles with these lists of bargain stocks, you can see that they are all kind of 1, 2, 3 million market cap, is they have very, very wide spreads. I like to look at this quotes page. I think the spread is on this page, but if it's not, we can always add it. If you click edit, you can add the spread to this page from the quotes page, from the quotes category. Save the changes, and you can see that some of the spreads make these stocks untradeable. Here's the spread. You can see that some of them have some of the stocks have 3 or 4% spreads, but some of them have got 60% spreads. And that means if you were to buy these shares, you would be almost out of pocket by 50% after you've just done your first purchase. So I think we can all agree that buying Ben Graham stocks in normal market environments is very, very dangerous, and it can hit your wealth significantly. So look at bargain strategies only when personally, this is how I do it. I only look at these lists when there's been big market routes. But you can use some of the metrics in your own screens. So moving swiftly on, let's have a look at the value investing segment. And in here, you can find more of the traditional, what I would call contrarian strategies. One of my favorite books is by a chap called David Dremen. He's one of the arch contrarians, and you can see that there are several strategies which are inspired by his book, which I highly recommend people go and dig out from Amazon. Just searching for David Dremen is well worth it. But you can see here, Dremen, low price to cash flow screen. If we go and look at how that's performed over the last few years, it has done very well. And he's basically trying to look for cheap shares, which have certain other factors. And you can see there's Barclay Homes in there at the moment. Some of the house builders are coming up a lot on these value strategies. In the book, we talk about improving the value basket returns. And some of the ways that we do that are by applying quality filters or by applying momentum filters. So let me just quickly show you one of the ways to do that. In that value investing basket, you will find some of the Piotrowski screens in here. Let's have a little look at the Piotrowski PE ratio screen. So in this strategy, it's very, very simple. Under rules, if you click on this page and you look under rules, you will see just two very, very simple rules for this strategy. We're looking for the cheapest 20% of the market by the P ratio. So there's a rank for the P ratio. And then we're filtering by this thing called the F score for basically the best stocks by this measure. This score's out of 9, and you can read up on it in the ebook. But this is, all the research shows that this has been a very market-beating strategy. It has done quite badly since probably about November last year, but SocGen's research suggests it has outperformed by 4 out of every 5 years over the last 20 years. Again, there are a lot of smaller stocks in here, but you can tweak these portfolios. So if you wanted to find and apply slightly different metrics to find better sets of stocks, you can do that. And I'll be showing you very, very shortly. Another way that people like to improve value returns is by applying other quality measures. So let's go to the quality metrics, the quality screens, which are here. And you can see you'll start finding some of the Buffett strategies. And, our own screen of screens is in here. So if we were to go and look at, for example, let's look at one of the Buffettology strategies. These have not done as well as one might imagine over the last couple of years. But if you look at the rules, you can see that there are normally some measures of value as well as measures of quality. Now, this can look like jargon to everybody, but I'm going to show you some very simple ways to screen very quickly to screen out for better value stocks. Beyond that, there are some momentum strategies. I talked about Joseph Lakonishok. Categorizing these screens is very, very difficult. But in momentum, you will find the value and momentum strategies, which is Joseph Lakonishok screen. And there's a couple here, Tiny Titans and Value Momentum, which have done exceptionally well over the last couple of years. Value and momentum is one of my own favorite strategies. And you can see how well this strategy has done over the last couple of years. Again, if you click the rules, you can see that this is looking for P ratios that is less than the median in the industry, and it applies what we call a couple of relative strength measures, which tries to highlight stocks that have been beating the market over the last 12-month period. So that shows you some of the ways to get to some of the strategies in the ebook, and I wanted to sort of illustrate some of the ways to do screening before I go on and show you some of the ways you can use stock reports as a value investor. So let me start from the basics. If you go up there in the top right, or you can create your own screen going up strategies and go and create a screen. Let me just start this up by going a value screen. Okay, if we want to find cheap shares, obviously one of the ways we can do it is a very, very traditional way of going into the screener and putting in the PE ratio and looking for stocks that are cheap by this measure. Now, as I said, I gave you some of those cutoffs. If we were to look for shares that are on a P ratio of less than 10 and sort by the PE ratio, descending, you can go and have a little look and get the qualifying shares. Now, in here, actually, I want to sort this, sort by the PE ratio, ascending, because this will show me lots of the very, very cheapest shares in the market. You will find in the cheap basket lots of rubbish. So, sorry, I shouldn't call companies rubbish. I am on record, but what I would say is there are a lot of the problem stocks. So it's not a surprise to find Quindel down there, which is one of the stocks everyone loves to hate at the moment. You will find stocks like Cam Kids, which was tipped by Simon Thompson earlier this year. It's done very badly. You will find old favorites like Tanfield, which have done, which used to be a huge glamour stock and has fallen back to earth. One of the things I like doing when I'm looking at any of these sets of stocks is to use the views on the top right here. If you click one of these buttons, that one there, which shows you the charts, it will show you this list in the same order, but as a set of charts. So with any luck, this will load not too slowly. Twiddle my thumbs. Let's hope we haven't lost our internet connection. But if you look down this page, you will find a lot of cheap stocks will have had very, very bad declining share prices. So seeing these charts go from top left to bottom right is a very normal occurrence in value shares. This is why one of the reasons that value investing works in inverted commas is because it buys shares at the point of most disgust. It buys. If you're putting a value strategy, you're buying shares that others cannot bear holding anymore. I would not personally be going out buying these shares in this list, but a lot of brave people might be happy to go and buy 30, 50 shares in a very simple list of stocks with maybe a couple more filters. Personally, I like buying. I like filtering. For stocks that are bigger than microcap. So if I'll show you how to do that, add a screening rule, click basic ratio, and you can just search for market cap. I'm going to use the pound version of the market cap, and I'm going to look for shares that, let's say, are at least larger than 50 million. I don't like particularly buying, the real small penny stocks, but this is a way to sort of separate this list. One of the things in the limitations in the screener at the moment I like to do is I like to exclude all dual listed stocks. So there is one little trick called is primary listing, and you can set that equals to 1, and you will just find the UK companies in the list. And we'll be putting this in as a checkbox in due course in the screener. But again, you can see some of this list. There are a lot of those. These are larger shares, and these are deep value companies. One of the things that you can do, I want to show a couple of dynamic ways to screen for cheap shares. So let me just take that rule off. I want to add a ranking rule. The ranks, you can rank any of the individual ratios on Stockopedia. So if I take the PE ratio, of course, you can do the same thing for the price to book, the price to cash flow. And you can see here it says rank in market greater than, and I'm going to make this greater than 80. Now this is looking for the cheapest 20% of the market. This is scored from 0 to 100. In the next version of the screener, this will be done by sliders. But if I just go click the button, I can find the cheapest set of stocks in the market just using a custom rank, which I think is pretty cool. You can then obviously add more filters, or you can also rank by its sector. So if you wanted to find stocks that were cheap against their industry or their sector group, you can use that in this way. There's also, similarly, there's a way to do this by using averages as well, if that's the kind of thing you're interested in. One other thing is, a lot of people are looking at the energy sector. If you want to find cheap stocks in the energy sector, click add a screening rule, click sectors industries, and you can go sector includes energy and mining, let's say. Energy and basic materials. There are 10 super level sectors which you can screen for on Stockopedia. And if you were to do this, bang, we've got 6 stocks by the PE ratio, which are in that very cheap bucket. And that is a list of stocks greater than 50 million, which I think, it shows you how to find value stocks in that sector. Of course, you can always use the value rank. The value rank is our own proprietary ranking, which blends 6 value ratios, and you can add it just using a simple ratio like this, value rank. and I can look for a value rank of greater than 80, and we might find a very different list. Because obviously, if you're just using the PE ratio, you need companies to be paying a profit. But a lot of sorry, let me add the value rank there. A lot of energy and mining stocks do not have earnings at the moment. So it's no surprise to find there are 30 more stocks here. And you can whittle this list down a lot more easily, by sorting by the value rank, etc. Which I think, again, is a fast way to find deep value shares in the energy sector. With all the problems in Russia, this is kind of like a nice way to go about it. So that shows you a couple of ways. Now let's talk about improving the returns to value shares. If we were to click edit again, you can see all we've got is the value filter here. Yeah, we've got a market cap filter and a sector filter, but let's see if we can add another screening rule. Now I was talking about adding momentum filters. You can use, for example, relative strength, which is one of the best metrics for finding shares with better momentum. I don't know if we're going to find any energy stocks. I haven't prepped this, but if you were to go 6 month relative strength greater than 0, that means that you're finding companies that have been beating the market since 6 months ago. I have not prepped this, so I wouldn't be surprised if we find 0 stocks. Okay, there's only 3 companies that have beaten the market in the energy sector that are cheap, and it's Griffin Mining, Gem Diamonds, and Evraz. I'll open that one to have a look at it later. Don't know them from Adam. But a better way when a sector is underperforming like this, we can use, instead of using the share price, we could use the momentum rank. Again, this is my preferred way of doing it. Let's try and find companies on a momentum rank of greater than 50. At least they've got better than 50% momentum. And our momentum rank blends price momentum, and it blends it looks for companies with improving broker estimates. So you can see here's a set of stocks, a few more stocks which qualify for that list: Lamprell, Rio Tinto, Griffin Mining, etc. And the other way to do it is to look at quality measures. I was talking about the Piotrowski F score, which sounds really complicated, but it's very, very simple. Sorry about that alarm. If we were to look for stocks, and this is scored out of 9, let's see if there are any shares which score better than 6 in this list. I have no idea if there are. Yes, there are still a few. So this is me showing you, taking that deep value basket and then improving it by applying additional filters, which are either momentum or quality filters. And we can add those to the table view by clicking that yes. And you can see these are companies that have got high F score. They're cheap by the value rank. They've got cheap, some of them have got cheap PEs, Evraz doesn't, but they've got good value ranks. All these ranks are scored out of 100, where 100 is best. So this is a way to go and find deep value shares, as I was talking about. So I would suggest have a play around in the screener. Let's go and look at some of these shares stock reports, because what I wanted to do is show you some of the things I look at on stock reports for finding value shares. So quickly, let's look at Gem Diamonds. I have not prepped this. I do not know this company from Adam. It's a diamond stock. I avoid energy and mining stocks like the plague, because I do not have a sort of expertise in there. And Warren Buffett would always say, "No one's circle of competence." I prefer to look at industrials, and I prefer to look at technology stocks. But for those who are into energy and mining stocks, it's very important I show you how powerful Stockopedia is for whittling down shares. Okay, you can look on the chart here. Don't know Gem Diamonds at all, but we can see up in the top right corner, one of the first things value investors will look for is the value rank. This is a value rank of 91 out of 100. It means that it is in that 10% cheapest bucket of the market, which I showed you earlier, has over the last couple of years had a tendency to outperform. So back on this chart, this stock is in the basket which would qualify for the green, where we're on the green line at the moment. It was not in the cheap basket when these were generated, but it is now. It's also got a high momentum rank and a reasonable quality rank. The quality, some of the things I would look for in terms of value, I immediately look at these traffic lights. For those who don't know the traffic lights, I'm sure you all do. This is not an orientation webinar. I have done those before where I explain things like the traffic lights in more detail, but very, very simply, long and wide and green means cheap. Thin and red means expensive or poor quality. So you can see here, the P is it's quite reasonable. It's 9 times. It's in that cheapest 20% of the market I was talking about. And in this valuation section, you can see it versus the market, which is this column, price to book value, price to tangible book, price to free cash flow. This company is looking quite cheap. And I hope I haven't picked a stock which has a data error, which would be funny. But it's again, you can see that this is flashing green. There, you can also see that there are some good quality metrics here, the return on capital, etc. Remember, if one is looking for a stock that potentially could be in that basket of shares which might outperform, one might look for more profitable companies, etc. The other thing is bankruptcy risk I always look at. I would be worried about this. I don't know if the company is highly levered or there are other issues with its financials, but bankruptcy risk is something I look at immediately. I always like to see a high F score. I was talking about this measure. We try and make these measures much more understandable on the stock report. But you can see this scores 8 out of 9. It's one of my favorite measures. I like to see the bankruptcy risk in any shares in at least in the safe or caution zone. I don't like seeing it down here. But in this section also on screens past, you can also flick through any of the stock screens that this qualifies for. There's the Laconoshock screen that I was talking about earlier. It's a value and momentum screen. And if you go and click through, we can see that this stock qualifies for this strategy. So it's had a 6-month relative strength. It's doing better than the market. Anyways, back to Gem Diamonds. To some of the other things I really like to look at as a value investor are up here at the top. There is this little box here called the margin of safety. Not many people use this, but it does show you any discount to the broker target. So at a glance, you can see there's a 36. The brokers are anticipating a 36% upside from here. It's slightly cheaper than its sector on a mixed basis, and you can click through from here and go and play with the inputs. So if I was to click this relative to the sector, I can actually see how this valuation is put together. You see the current price here and the implied valuation by this against its sector. And what this does is it looks at all of Gem Diamond's ratios, the PE, the price to book, etc., and looks at the median for the sector, and it basically says what would be, if you were to value Gem Diamonds to be valued exactly the same as the sector, what would be the implied price? And if you don't want to use some of these ratios, you can remove them and revalue the stock, and it will come up with another valuation measure. But you can see here that all of these valuation calculators are quite useful. Just to show you what a deep value stock might look like at the moment, PV Crystalox Solar, which is a solar company. It's ranking quite highly on our systems. But if you look at this margin of safety box, there is sometimes in deep value companies, you'll see this liquidation line, which is something I like to keep an eye out for. But this shows for stocks that are trading at less than Ben Graham's measure of liquidation. So this means the stock may be on the price to net current asset value strategy or the net strategy that Graham's favorites. But if you click through, you can then see how that's calculated again. So those are other kind of like nice little tools for value investors on the site. So I think that's quite useful. If you don't understand any of the terms on the stock report, of course you can click and get the definitions. Try and read the text, understand it. You can also find other screens in which this is used in. So let's say you don't really understand the P ratio. You want to know how it's used. Click the P ratio, and you can find a couple of strategies that it is used in down here in this section. So for example, looking at any of these price to sales, you can find quite a lot of strategies where the price to sales is being used. And if you click through, you can then go look at that strategy and look at the rules and see what kind of rules are being used for that metric, which I find is quite helpful. One other thing I wanted to show you before I take some Q&A, if you were to click on any of the table views on Stockopedia, you can, for example, click this value tab. Right on this the standard table views, there is a value tab. Click it, and it will load all the value ratios. Again, it can seem like jargon to people who are less experienced in investing, but at a glance, you can sort by the price to earnings, price to sales, some of those metrics I was talking about, and you can look at them in comparison to the value rank. And the value rank, this is my preferred rule of cheapness on the site. But you can see often how that's composed by some of the inputs. So the P, the price of sales, price of free cash flow, they're all inputs into it, and you can see how they might have impacted it. Also, you can click the value rank on a table, and it will show you the breakdown of actually the actual inputs to that ranking, which is another really useful way of figuring out why something is marked as cheap. You can also click edit on this table. And there you will see you can then edit and change the columns. So if you didn't know, or you only wanted to look at certain value ratios, you can remove some of them. You can just put in your own preferred measures. Let's say if you're somebody who prefers to use enterprise value measures, you can add all of those, move them all around, save the changes, and you've got all your preferred measures there in the table. A lot of more experienced investors like to use enterprise value instead of let's say enterprise value to free cash flow rather than price to free cash flow. I'm not going to go into explaining enterprise value, but because that could take a lot more time. But if you are an investor who likes to use those metrics, that's how you can get them in your tables. So you can customize these views exactly how you like. So that's pretty helpful. And anyway, I think that's pretty much what I wanted to cover. There are other things that I could talk about before I open it up to Q&A. But a couple of things. I wanted to show you some of our proprietary metrics. I can also do a stock screen. Oh yeah, before I do that, if you're ever stuck with any of this terminology, go up to the help menu, go down here and click glossary of terms. It's right here on the right. There's lots of links in the help menu. Do look around. But if you go on here and then you click valuation in the table of contents on the right, you can look at all the different valuation ratios we have. And there are lots of super metrics in here. And even just looking at this list, you can find things like special Ben Graham metrics that we have blogged about in the past. I'm not going to go into the details, but there are some super things in here. There's the Graham and Dodd PE, which is a 10-year PE. If you read the Telegraph, I'm not sure if it's been published, but I've just been helping them out to find all the stocks which are cheapest by their 10-year average earnings. And I use the Graham and Dodd PE to do that. So if you were to do this, you can click on here. If there's no screens which are, for example, you sometimes can find, just clicking through it, you can find a guru screen that this is in. The Ben Graham Deep Value Score is actually being used in one of the newer stock screens that I've set up on the site, which is here. And so there are some super metrics like this which are hidden away in that glossary of terms, and you can screen by them. So it's read the ebook, try and get to know a little bit more depth. I think in summary, if you don't know all the metrics, start with a value rank. In James O'Shaughnessy's What Works in Wall Street, he went through a very similar version of and showed how the value rank, or what he called the value composite, outperformed in almost every sector, and it worked better than P ratios, price to book ratios. So just starting with a value rank is a great way to get started in value investing. You should, but always try and sort of deepen your knowledge and understand the more depth in some of these metrics and where and how they're best used. A couple of these other books, well worth reading if you want to go beyond how to make money in value stocks. These are deeper tomes. This one's only 150 pages on the left, but the others are much heavier. Another thing to do is to keep an eye on site editorial. I'm sure lots of you are on Paul Scott's mailing list, but we have a good editorial team, and one of the ways to stay on top of editorial, go up to the home menu, and in regular columns, you can go to the small cap value report. This is Paul Scott's daily column. He is incredibly prolific, and you can see even today he's been writing away on this first column. And he gets so many comments, and there's a real crew of great value investors in here who all love to dig for cheap small cap shares. So this is a great place to come and find ideas, and then you can check their stock reports, etc. Another thing is to go and check. Another thing is to go and look at some of our old blog courses under the help menu. Go on blog courses, and in there you will find how to value stocks, and you'll also find a value investing section. You can go in there and go and read lots of the archives of some of the best value investing articles that we've done, many of which ended up in our ebook. But for example, if you just wanted to go and find 5 ways to find bargain stocks in any market, it's right there. This is one of Ben's articles. It's been very, very, very popular. It's got 16,000 reads. But again, you can find some of Ben Graham's best ways of looking for bargains. So lots to dig into, lots of value investing resources. I'm going to ask a few questions. I've gone on a little bit too long. Okay, one moment. I'm going to go. I haven't looked at any of the questions to date. Sorry if... Okay, great. Just going through your questions. I was very paranoid for a moment because I saw that you said there was no sound. Before I answer the questions, if anyone is still thinking of signing up or wanting to upgrade, I will honor for current subscribers this code for taking international stocks. If you wanted to go and look at Apple and Facebook and all the great American stocks, there's lots of cheap American stocks as well as expensive ones. You can use this code WebinarIN. Just ping me using the green button on the website and I will get you set up. But there's a couple of codes. Right. Why have I got a preference for the quality rank versus the Piotrowski score? Well, actually, I'll let you know the Piotrowski score is 30% of the quality rank. We wanted to add in certain other measures of quality. I wanted to put in a bankruptcy risk filter, which reduces the score for bankruptcy risk, etc. The quality rank incorporates the Piotrowski score. A lot of people, for example, SocGen, Societe Generale, if you read any of their research on the F score, you will find that they actually use just the F score and a bankruptcy risk filter as their quality scores. For those who don't know what I'm talking about, it's this measure here in the health trend. If you click it, you get this wonderful pop-up checklist, which shows you and breaks down exactly how the F score is calculated with 9 questions that are placed on a company's accounts. It's a terrific measure of quality, and it's been shown to be hugely predictive in small caps. So it's really worth getting to know. The quality rank uses it as about 30% of its components. So bear that in mind. I'm going to keep going through these questions. Ed, you mentioned earlier the screen of screens. We do get asked this a lot. The screen of screens is available if you go into quality investing. It's basically a strategy, and I'll post the link here into the chat window. There you go to find the screen of screens. This selects the stocks which qualify for the most of the other guru screens on Stockopedia. So we create a count of the number of screens that a stock is qualifying for, and we've got about 65 of these guru strategies, and it simply buys the stocks. I say buys, I say it selects the stocks which are qualifying for the most of them. So you can see on here, in the column, number of screens that it's qualifying for. You can see there's a lot of house builders qualifying for a lot of screens at the moment. I actually own some Persimmon. I own Barrett. I own quite a few of the house builders. And some of these are showing on the screen of screens. The screen of screens can be kind of thought of as a blended approach. It's got value stocks in it, dividend stocks, quality stocks, momentum stocks, and generally it finds slightly more defensive shares. But you even find things like NIBU, deep value share, is on that list. I personally, it's on my barge pole rating list, but a lot of people who've been reading Simon Thompson of the IC are in that share. I've learned to avoid all Chinese AIM stocks because I had some bad experiences in them in 2008. And now my entire rule of thumb is never to buy a foreign company that has that is from China on AIM or Asia on AIM, because if they don't have a listing abroad as well. So that's my barge pole rating list. But there's sort of defensive stocks, there are deep value stocks, etc. on this list. So hopefully that explains it. If you go up actually you can also there should be, if you, on all of these strategies, by the way, you can click the Learn tab or the link here, which says click here, and it will take you through to an illustration and a discussion about that strategy. The Screen of Screens was featured in the FT, by David Stevenson, and so we got a lot of publicity for it there. Okay, I'm going to rattle through some more of these questions. Which combination with value works well is preferred? Growth, momentum in general, and in combination backed by good research. I think I've kind of answered that. I think there's two. I don't know if you've seen I've got this Venn diagram I wasn't going to show in this webinar, but if I open one of my previous webinars, I'm sure I can show you. I think in the orientation webinar, I might have had a slide. Yeah, it's this slide. And it shows you a kind of Venn diagram that shows you value, quality, and momentum. I think growth is a part of quality, really. But the kind of value investing works best when it's blended with quality or momentum. So these crossovers between value and quality are where you would find the great investors like like Warren Buffett, Joel Greenblatt. Between value and momentum, you'd find James O'Shaughnessy, Joseph Lakonishok. You would find more of the kind of academics and quants in there. And it's these two buckets, which value and quality and value and momentum, where people generally find where you find that returns are most improved in the stock market. I'm saying they are. I can't promise the future is exactly the same as the past, but I believe that these things which have worked for 50 years should continue working in the next 50 years. I mean, if I was to show you, for example, like a couple of the stocks I own, I own Barrett at the moment. I have owned it for a while. I personally like buying stocks which are showing at least 2 out of 3 of the stock ranks above 80. That's my rule of thumb. I like seeing. I'm personally, I'm less of a value investor. I treat value pretty much similarly to quality and momentum. I'm very happy to buy shares at high quality and high momentum that are more expensive. But my rule of thumb, because I've designed the whole ranking system, is to only buy shares which have at least 2 out of 3 of those core components higher than 80, because that means they're in the best 20% of the market. I'll show you another one that I've owned a lot of this year, Salmar, which I'm thinking about buying again, which is cheap, value rank of 84, quality 90, and momentum 77. So it's got a very high stock rank. A lot of these Norwegian salmon farmers I've been on record as saying have looked very good all year. They've sort of been coming off a bit lately because of they've been going against the headwind of Russian sanctions. But again, I think it shows you want to be blending these factors. So hopefully that's useful. And if you wanted to screen for it, you just go into the screener, and you can just very, very quickly knock up a list. If I was to go value and momentum, I can just go value rank greater than 90. I can go momentum rank and rank greater than 90. And I can very quickly get a list. I'm calling this VM. I can show you an even quicker way of finding shares like this. And this will quickly whittle it down to a set of stocks which are looking very good for their value and momentum. I don't know if you've seen, there's a friend of mine called Ed Xing, who's a sort of a systematic global equity manager. And he uses Stockopedia to isolate shares for his very large systematic equity fund. Just to show you, there's also these crossover ranks. If you don't want to filter just for value and momentum on their own, you can use what I call the crossovers. You can see under the ranks there's QV, VM, and QM. VM means value and momentum, and I can restrict this list to all those which have got value and momentum rank combined of 95 plus. So that's another very quick way, and you can do the same for quality and value. You can look for the QV rank, as I was showing earlier. So this is useful ways of highlighting. Yes, the webinar is being recorded. I've got one more question. Broker forecasts on the site include revenue and earnings. Will there be greater disclosure in the future of forecast EBITDA and EBIT? I'd love to say yes. We have a relationship with Thomson Reuters, who provide our raw data. So for example, if I'm to go and scroll down, you can see here, at the moment, we're only licensed to show profits, say profits, earnings per share, dividends per share, and sales. We are not licensed to show forecast data for EBITDA, EBIT, and other more granular data. I anticipate that in future we will be able to do this, but they will be at higher prices. So it's really a licensing thing between us and Thomson Reuters, and also they don't want to sort of, I would say they don't want to create competition with their institutional product. So it's something that we may be able to do in future, but certainly for certainly for a higher price. But I can't promise it right now. Right, if there are any more questions, do fire them right now. The webinar is being recorded with any luck, and I will put this online hopefully within 24 hours. Thanks a lot for listening, and I hope it was useful. I hope you've got something out of it. All the best. Happy Christmas. Once again, if you are thinking of signing up, haven't already, there are a couple of webinar codes available. So please do sign up over Christmas and have a good dig around. And if you want to upgrade and look at US value stocks, please do. Thanks a lot. That was an hour, just about kept it to an hour. Take care and see you in 2015 when we will be doing a lot more of these webinars, and we will be doing a lot more granular, how the stock market works webinars. So thanks for listening. Take care and speak soon.